Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 12th of August. I'm Daniel Lam, your host for the podcast. As we are building up for the US CPI figure that will come out in the evening in East Asian time today, I want to revisit the non-farm payroll missed earlier this month. So I'd like to point out that the weak payrolls data on the 1st of August included large downward revisions for May and June, suggesting that the US economy added 258,000 fewer jobs than previously believed over that period. At the headline level, surprise revisions like these are actually extremely infrequent. Outside the COVID period, the Bureau of Labor Statistics (BLS) data suggests that such revisions have not occurred since the 1980s. And non-farm payroll releases are more likely to be revised downwards, i.e. fewer jobs added during economic downturns. The negative revision of 133,000 for the month of June is especially interesting because new data was the key driver there, while the May revision was more a result of seasonal adjustments. So this means that companies which did not respond to the BLS soon enough to feature in the initial release also added far fewer jobs than the BLS initially estimated, a sufficiently large effect to pull June headline payrolls growth significantly lower. Now, this is not to say that negative revisions only happen during economic downturns. They've also occurred during US economic upturns as well, such as over the last 5 years. But the recent sharp revisions to employment growth does raise an interesting question. If next month's NFP's print is strong, can that be trusted? Well, we believe that the data should be received with some dose of skepticism, especially against the backdrop of softening economic data elsewhere. A strong print is more likely to be downgraded than a weak print is to be upgraded, given biases in how NFP data is collected and where we are in the business cycle. So historically, these revisions are most likely to appear in the second release. For example, the June NFP print released on the 1st of August. So the fact that the NFP is more likely to be prone to downward revisions during times of weaknesses in the economy suggests that the accumulation of portfolio hedges is something that investors should be thinking about. Now, we favor adding gold on pullbacks, especially if it goes to the 3,000 to 3,250 area. We also like scaling into bonds with preferred maturity profile of 5 to 7 years when the US 10-year government bond yield is in the 4.25 to 4.5% area. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.